Let's get the take for your state of the market right now, given what we saw with the jobs report, given what we saw with the firing of the Labor Department's chief statistician. Is this a cause for concern with regard to how investors should treat the current market environment?
Yes, we do think it is a cause for concern. We think that the market in the long term is going to continue to go higher, but there are going to be concerns related to the deficit, to the tariffs, and particularly with this employment report, what the Fed's next move is. Because right now it is quite obvious that the Fed should cut in September, given the economic data we have.
So given what you saw, you do believe that the Fed maybe is behind the curve because of the jobs data and the revisions that we saw?
I think that yes, that is correct. I think that right now the Fed should cut in the next meeting, in the September meeting. I think that's the most likely scenario. If that does happen, that is going to stimulate the housing market if we get into a rate cut cycle, and the GDP multiplier effect on the housing is very substantial. It'll be good for the economy, it'll be good for the markets. But along the way, we are going to see volatility and we are going to see pullbacks in the market, which investors should be prepared for.
What do you make of the market reaction to that jobs report? If it in fact was a report that could have led some to believe, including yourself, that the Fed will cut interest rates perhaps even imminently, why hasn't that been more of a positive for the market reaction rather than what we saw on Friday? We're seeing a bit of a bounce back now, but this is back to a bad news is bad news or a good news is good news regime?
Yeah, well, I think the market is really concerned about the Fed because of Powell's hawkish commentary, right? So the market is not sure whether the Fed is going to do the right thing or not. But in our view, Powell will make the right move, will cut the rates. Potentially, that'll be good for the market. But in the meantime, because of this uncertainty, we will continue to see volatility.
All right, Aadil, let's go through the word of the day. What is your word of the day and how does it fit into the narrative right now?
Recalibration is the word of the day. I think a lot of investors, Dom, are very overly focused on the tech sector. A lot of these mega cap tech companies are trading at premium valuations. This is going to be your area of vulnerability when the market does fall, similar to what you saw last week with Amazon pulling back. Also on Friday when the market fell, tech led the decline. So we think that investors should recalibrate their portfolios, book some profit in the tech holdings, spread the love into other areas of the market like utilities, energy, financials, gold. These areas of the market will outperform when the market falls.
All right, that brings us to our mystery chart, because your top pick is not one that we would normally say is a momentum-ish type name. What is that mystery chart revealed?
So we really like the energy sector over here, even though it is, as you mentioned, flat for the year, but we think that there's deregulation tailwinds. Just last week, we heard the EPA repealing the 2009 endangerment finding. We do feel that as Trump unwinds some of Biden's clean energy policies, this will be positive for this sector. Also, as he's making these trade deals, the exports for U.S. energy is going to increase, like with the European Union committing to buy about $750 billion of U.S. energy, with South Korea committing to buy about $100 billion of U.S. energy. What is that going to benefit? The large oil companies like ExxonMobil, which are trading at relatively low valuations and paying a good dividend as well.